The 2008 financial crisis is often described as a housing crash, a banking failure, or a Wall Street disaster. But those explanations only scratch the surface. The real story is far more unsettling, because it reveals how an entire financial system quietly turned risk into profit, while pushing the consequences onto ordinary Americans who never agreed to the gamble. This crisis did not begin in 2008. Its roots stretch back decades, to a time when finance slowly transformed from a tool that supported the real economy into a machine designed to extract maximum profit, regardless of long-term consequences. At the center of the crisis was housing, but not because Americans suddenly became irresponsible borrowers. In the early 2000s, interest rates were kept historically low after the dot-com crash and the September 11th attacks. Cheap money flooded the economy, and banks were desperate to lend. Homeownership was aggressively promoted as the American dream, not just socially, but politically. But banks were no longer interested in holding mortgages. They discovered something far more lucrative: securitization. Instead of lending money and waiting 30 years to be repaid, banks bundled thousands of mortgages together and sold them as financial products called mortgage-backed securities. These securities were then sliced into layers, some considered safe, others risky, and sold to investors around the world. Here's the untold part. Once banks stopped holding the loans, they stopped caring about whether borrowers could actually repay them. This is where subprime lending exploded. Loans were given to borrowers with weak credit, unstable income, or no documentation at all. Adjustable rate mortgages were pushed aggressively, with low teaser rates that would later reset to unaffordable levels. Brokers earned commissions for volume, not quality. Risk was someone else's problem. And that someone else was often pension funds, insurance companies, and retirement accounts, money belonging to teachers, firefighters, and ordinary workers. To make matters worse, credit rating agencies played a critical role in disguising danger as safety. Many of these mortgage securities were rated AAA, the same rating as U.S. government debt, despite being built on fragile loans. These agencies were paid by the very banks creating the products, a conflict of interest baked into the system. As long as housing prices kept rising, the illusion held. Refinancing masked defaults. Rising equity covered bad loans. Everyone believed housing could only go up. But housing prices don't rise forever. When interest rates began to climb and adjustable mortgages reset, homeowners started missing payments. Defaults rose quietly at first, then rapidly. Housing prices stalled, then fell. Suddenly, refinancing wasn't possible. The entire structure depended on constant price growth, and once that stopped, the system unraveled. The true panic came when banks realized they didn't know how much their assets were worth. Mortgage-backed securities were traded in complex markets with little transparency. As defaults increased, buyers disappeared. No one wanted to touch these assets, because no one could calculate the risk. Balance sheets across the financial system became contaminated with uncertainty. This is when trust, the lifeblood of finance, collapsed. In September 2008, Lehman Brothers failed. Its collapse wasn't just symbolic, it shattered confidence globally. Credit markets froze. Banks stopped lending to each other. Businesses couldn't access short-term funding. Payrolls were threatened. The modern economy began to seize up in real time. Meanwhile, ordinary Americans were already suffering. Millions lost their homes. Foreclosures spread through neighborhoods, destroying property values and local tax bases. Retirement accounts were crushed. Unemployment surged. Families who had done nothing reckless found themselves paying the price for decisions made far above their heads. Then came the bailouts. The U.S. government stepped in with massive rescue programs to stabilize the financial system. Trillions of dollars were committed through direct bailouts, emergency lending facilities, and guarantees. The justification was clear: letting the system collapse would have caused even greater devastation. But here's the untold truth that still fuels public anger today. Very few executives faced consequences. While banks were rescued, homeowners were largely left to fend for themselves. Mortgage modification programs were slow, complex, and limited. Foreclosure relief arrived late, if at all. The recovery that followed was uneven. Asset prices rebounded quickly, benefiting those who already owned stocks and property, while wages stagnated for years. The crisis permanently reshaped American society. Trust in institutions collapsed. Wealth inequality widened dramatically. The middle class lost trillions in net worth, much of which never returned. Meanwhile, financial markets grew even larger, more complex, and more interconnected than before. Perhaps the most disturbing part of the 2008 crisis is this. Many of the structural incentives that caused it still exist today. Banks remain enormous. Financial products remain complex. Risk is still often hidden behind models and assumptions. And when trouble appears, the expectation of government intervention remains. The untold story of 2008 is not just about greed or failure. It's about a system that privatized profits and socialized losses, and a public that was never given a real choice. Understanding this history matters, because financial crises are never just accidents. They are the result of incentives, policies, and decisions made over time. And when the lessons are ignored, history has a way of repeating itself. The question is no longer whether another crisis will come, but whether anyone will be ready when it does. What really changed, and what didn't? After the immediate collapse was stopped, many Americans believed the worst was over. Banks were stabilized, markets recovered, and headlines declared the crisis contained. But beneath the surface, the real consequences of 2008 were only beginning to take shape, and they would quietly reshape the U.S. economy for the next generation. One of the least discussed outcomes of the crisis was how it transformed the Federal Reserve's role in the economy. Before 2008, the Fed primarily adjusted interest rates. After 2008, it became the backstop for the entire financial system. Through emergency programs and quantitative easing, the Fed injected trillions of dollars into markets, buying mortgage-backed securities and government bonds to restore liquidity and confidence. This intervention saved the system, but it also changed it forever. Financial markets became dependent on central bank support. Asset prices rose not just because of economic growth, but because of abundant liquidity. Stocks, bonds, and real estate recovered quickly, while wages lagged behind. This created a deep divide between those who owned assets and those who relied on income alone. In other words, the recovery favored Wall Street far more than Main Street. For millions of Americans, the years following 2008 were marked by job insecurity, stagnant wages, and declining economic mobility. Young workers entering the job market faced lower starting salaries. Older workers struggled to rebuild retirement savings. Homeownership rates fell, particularly among younger and middle-income households. Meanwhile, large financial institutions grew even larger. Despite promises to reduce risk, consolidation accelerated. Banks deemed too big to fail became even more central to the system. Complexity increased. Financial engineering returned, this time under new names and structures. Risk never disappeared. It simply became harder to see. Regulatory reforms like the Dodd-Frank Act were introduced to prevent another collapse. Stress tests, higher capital requirements, and oversight mechanisms were put in place. These measures reduced some immediate risks, but they did not eliminate the core incentive problem. Profits remain private, while losses are often absorbed by the public. Another untold consequence of the crisis was the loss of faith in institutions. For many Americans, 2008 shattered the belief that hard work alone guaranteed stability. People watched banks receive bailouts while homeowners lost everything. Executives kept bonuses while workers lost pensions. This disconnect fueled public anger, distrust, and political polarization that still shapes the country today. The crisis also rewired how Americans think about debt. Household borrowing slowed for years after 2008, not because conditions improved, but because confidence collapsed. Credit standards tightened. Young families delayed buying homes. Student debt quietly replaced mortgage debt as the primary burden for a new generation, often with fewer economic rewards. And while housing recovered in price, housing affordability never truly did. In many cities, investors purchased distressed properties in bulk, turning homes into rental assets. This reduced supply for first-time buyers and pushed prices higher. What began as a housing crisis slowly evolved into a long-term affordability crisis, one that still defines the U.S. economy today. Perhaps the most important lesson of 2008 is how fragile modern financial systems truly are. The crisis showed that risk does not disappear when it is spread. It accumulates. Complexity does not eliminate danger, it disguises it. And confidence, once lost, can vanish faster than any model predicts. Even more troubling is that many warning signs were visible before the collapse. Rising leverage, asset bubbles, over-reliance on models, conflicts of interest. These were not hidden secrets. They were ignored because the system was profitable. That same dynamic exists in every major financial cycle. Today, the global economy faces new risks: record government debt, rising interest rates, complex derivatives, and heavily leveraged markets. While the instruments have changed, the behavior often hasn't. The untold story of the 2008 financial crisis is not just about what went wrong. It is about what society chose to tolerate. A system that rewards short-term gains over long-term stability will always drift toward crisis. A system that protects institutions more aggressively than individuals will always deepen inequality. And a system that forgets its own history is destined to repeat it. Understanding 2008 is not about fear, it's about awareness. Because the next crisis will not look exactly like the last one, but it will follow the same pattern: rising confidence, hidden risk, sudden shock, and widespread consequences. The real question isn't whether another crisis will come. It's whether this time, the cost will fall on the same people again. Why it still haunts the global economy more than a decade after the collapse. The 2008 financial crisis is often treated as a closed chapter, a painful lesson already learned. Markets recovered, banks stabilized, new regulations were introduced. But the deeper truth is far more unsettling. 2008 never truly ended. It merely transformed. The crisis fundamentally changed how economies function, how governments respond to risk, and how financial markets behave under stress. And many of today's most dangerous vulnerabilities trace directly back to the decisions made in the aftermath of that collapse. One of the most profound legacies of 2008 is the normalization of emergency economic policy. Before the crisis, aggressive central bank intervention was considered a last resort. After 2008, it became standard practice. Quantitative easing, zero interest rates, and massive liquidity injections were no longer extraordinary measures. They became routine tools used to stabilize markets. While these policies prevented immediate collapse, they also encouraged unprecedented levels of debt. Governments borrowed heavily. Corporations refinanced endlessly. Investors took on more risk, assuming central banks would always step in. This created an environment where leverage flourished and caution faded. The system became addicted to cheap money. As a result, financial markets grew increasingly disconnected from the real economy. Stock prices soared even when wage growth stagnated. Asset owners benefited enormously, while workers saw little improvement in living standards. Wealth inequality widened, and economic mobility declined. This wasn't an accident. It was the mathematical outcome of policy choices made after 2008. Another lasting consequence was the erosion of market discipline. In theory, capitalism relies on failure to enforce responsibility. Poor decisions should carry consequences. But in 2008, the largest institutions were rescued because their collapse threatened the system itself. This created a dangerous precedent. If an institution is big enough, it may be protected regardless of behavior. That expectation still shapes decision-making today. Banks, hedge funds, and large corporations operate with the understanding that systemic importance brings implicit protection. This does not eliminate risk, it concentrates it. Smaller participants bear the downside, while the system shields its largest players. The crisis also reshaped housing in ways many Americans don't fully realize. Homeownership was once the primary path to middle-class wealth. After 2008, millions were locked out of that path. Investors and corporations stepped in, purchasing distressed properties at scale. Homes became financial assets rather than places to live. This shift helped drive today's affordability crisis. High prices, low inventory, and rising rents are not isolated problems. They are the long-term consequences of a housing system altered by crisis-era decisions. Perhaps the most troubling legacy of 2008 is how fragile trust has become. Public confidence in financial institutions, government oversight, and economic fairness was deeply damaged. Once trust erodes, societies become more polarized, more reactive, and more vulnerable to instability. This erosion of trust still defines political and economic debates across the United States. And yet, many of the warning signs that preceded 2008 are visible again, just in different forms. Today, Risk is concentrated in areas like leveraged loans, private credit markets, commercial real estate, and sovereign debt. Complexity has increased, not decreased. Transparency remains limited. And global financial markets are more interconnected than ever. History doesn't repeat itself exactly, but it rhymes. The same cycle of confidence, leverage, and complacency is always present before a collapse. The same belief that this time is different appears in every era. And the same people often pay the price when that belief proves false. The untold truth about 2008 is not that it was unpredictable, but that it was politically and economically inconvenient to stop. Addressing the underlying problems would have required limiting leverage, reducing financial complexity, and prioritizing long-term stability over short-term growth. Instead, the system was stabilized and allowed to continue, larger, faster, and more dependent on intervention than ever before. This doesn't mean another crisis is guaranteed tomorrow, but it does mean the system remains vulnerable. Financial stability is not built on optimism. It is built on discipline, transparency, and accountability. When those foundations weaken, risk accumulates quietly, until it doesn't. The legacy of the 2008 financial crisis is a warning written into the structure of the modern economy. Ignoring it doesn't erase the risk, it increases it. Because the most dangerous crises are not the ones we fear. They are the ones we believe can't happen again.